Hello, everyone. Today on the final bar, we'll wrap the week, our normal Friday routine of looking how things have evolved Friday close to Friday close. This Friday certainly was all about market bouncing higher, what we may call a dead cat bounce. I think people will be actively debating if this is the bottom, if we've now found the bottom as stocks bounce higher and really materially higher across the board, with the strongest sector up 4%, the weakest sector still up 0.7%, or is this the next leg lower coming next week? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of StockCharts, using data visualization, visualizing investor psychology, decision-making, all the fear and greed, the buying and selling, all mashed together, and it comes out in the form of a chart. So everything that we can think about in terms of understanding the emotional state of investors, understanding supply and demand, trying to navigate all of the macro factors and everything, the charts really should tell us that composite of vote of the investors, right? And what you saw today was certainly a rally. The market sold off going into around 11:30 Eastern, and from there took a big left turn and just chipped away higher and higher. The S&P closing almost up 2%. What does that mean for the long-term trend? We're going to look at all of that and more here in a minute as we wrap the week. Before then, though, I just want to let you know about some upcoming guests we have on the show next week. On Tuesday, we have Jesse Felder from the Felder Report. On Wednesday, Dana Lyons from the Lions Share Report. On Thursday, Willie Delwich from All Star Charts. Then on Monday, March 22nd, Chart Madness, which is our bracketology special. We will have 4 experts, myself, Grayson Rose, Greg Schnell, Tom Boley, taking a bracket of 16 stocks, debating their strengths and weaknesses, and coming up with our final 4 and our champion picks of what we think has the best opportunity going forward. We can track those picks. You can follow along during the special, then track them going forward and see how we all selected. Let's get to our Wrap the Week segment, focusing on how the market has evolved from last Friday to this Friday. Before we get there, let's update on a survey question we asked. This is actually really relevant to a take a step back sort of day, because it's asking which of these 4 buckets performs the best through the end of the second quarter. So looking forward way out, 4 months out, going to the end of June. Large cap growth, large cap value, small cap growth, small cap value. What I am not surprised at is that 60% of you voted for one of the 2 small cap answers, small cap growth or small cap value. 40% of you picked one of the large cap segments. The most respondents with 37% was small cap growth. There's a number of different ways you can sort of look at that, but IWO is usually the way that I would do that. So there are ETFs that track different ones. There are S&P 600 ETFs as well, but the Russell 2000 growth is IWO. And what you can see here is something that's had a pretty solid trend up until about a month ago. And from then you've had this pullback. And the question, as we saw today, what is this? Is this a pullback within a much longer term uptrend? Is this the first of multiple legs down? And either way, what you see here, it's a little hard to see the candle here, but that's a little hammer candle there where the open and the close are at very close to one another and at the highs of the day, and you have a long lower shadow. Think of it as hammering out a bottom, represents some short-term strength. But we're talking more about the long-term trend. And I agree with the idea that small over large, I think that continues to work. Growth over value is an interesting one because small cap value, if you look at IWN, that's been one of the better places. That's where the relative strength has been. If I had to pick one, I would probably pick small cap value because this is going to be things like energy stocks and some financials and others that have really shown some strength. We'll have to see. The question is, how much of a pullback, how much of a digestion period, a correction period do we have before we resume the uptrend? Going to our weekly wrap here, let's just start with the chart of the S&P 500. What What the chart tells you today, what today's action tells you is, Jim Cramer earlier this week did his 5 stages of I'm trying to think what he called it, five stages of dealing with the bear market. I'm paraphrasing, it was something like that. But the 5 stages of the bear market, the first step is disbelief. And I would argue we're still there, because most people, the fact that the stocks do what they did today tells you that people are not believing that a bear market phase is upon us. And again, whether it's a short-term tactical bear, whether it's a corrective period of a couple weeks to a month, that's still sort of a bear market process that we have to get through. We're still in the disbelief phase. The idea that some of these stocks that have had incredible runs have pulled back just about enough. We can ride them now the next leg higher, and we continue and continue and continue. There are later stages where you get to, acceptance, which is the final stage, and it's different parts of it where, you have to deal with, you acknowledge the fact that the market's going lower. You get really despondent thinking, oh my gosh, how low is it actually going to go? The very end of it is acceptance and just sort of, dealing with the fact that it may never go up again. And that's when bear markets tend to end. So again, I still feel like even if there's a short-term correction that we're in, a day like today feels a little more like a dead cat bounce, which was a horrible way of describing a market that overall is in a bearish phase. But you get these quick snapbacks to the upside that will suck some people in because it feels like everything's better again. But when you look back, nothing much has changed from yesterday to today in terms of the overall environment. I still think there, a lot of stocks need to come down further to alleviate the euphoria that we've had up until today. And that's why I would expect further downside. Having said that, the S&P closed below its 50-day moving average yesterday. On Thursday's session, it closed back above it. So if you're looking for follow through, looking for an indication going into the weekend that we have a lot more downside, I'm not seeing that as much. I'm seeing more hammer candles. I'm seeing short-term, bounces, which argue that that the next couple days going into the beginning of next week probably going to be a little more of a bounce. But overall, the trend remains negative. How you figure out when the trend is not down anymore, it's a couple things, but most importantly, look at the highs and the lows. We are potentially establishing, it's all about where we're at relative to 3,700. That's the January low on that medium-term time frame. That's where I'd be looking. In the short term, are we able to put in some sort of higher low going into next week? Do we break above a trend line using the previous highs? That would tell me, okay, I guess that was it. This is just a short-term pullback and we resume higher. I think that's unlikely, but it's certainly possible. And that's what would tell you that the bearish thesis is incorrect. As always, you always have your base case, you have what you're planning on, and then you look at what alternate scenarios might look like, and be mentally prepared for those to happen at any point, because they certainly can. Now, wrapping the week basically means let's look at the last 5 trading days and see how things have evolved. So if we start the clock last Friday and just look at the percent moves, sorry, I ran out of time to label all these, but I can give you the last couple labels so you know it. The S&P 500 here in the middle ended up closing the week up about 0.4% from last Friday. So that's not a huge move. And again, a lot of that gain came today when you had the nice bounce higher. As of yesterday, we were down about 1% for the week. So recovered a little bit. What underperformed stocks? Emerging markets up 0.25%. Small caps actually down 0.3%. Gold and what is this? The NASDAQ 100 both down around 1.7%. The weakest of all bonds down almost 3%. That's using the TLT as sort of a proxy for bond prices. What outperformed stocks? The dollar actually finished a little bit stronger and had a pretty decent week. And this rotation from weaker dollar to stronger dollar is certainly a different vibe than we've had for quite a while. The dollar index closed up about 1%, and that's using the UUP, by the way. What else outperformed stocks? 2 key assets: crude oil, which was the best of the bunch, up 7.6%. Bitcoin finished up 6.5%, and again, decent week overall for those two. Now you can tell, obviously, energy stocks have been the juice. That's been the strength this week. And even on days when everything else was down, energy managed to be up. Even this morning when things were kind of down, you saw energy was still up, and then everything sort of caught back up and reverted back higher. So those charts of energy stocks remain pretty positive. And not to jump around too much, but when I'm looking at the top 10 ranked scooter names, I'm seeing some media entertainment names. I'm seeing energy stocks. I'm seeing, Marathon. I'm seeing XCC, Devon Energy, Fang, Occidental. Half the top 10 are all energy stocks, and that tells you about this move higher in those spaces. Yesterday, if I remember right, Ari Wall to show the chart of the high beta versus low vol, and that's really speaking to the strength of that energy trade. Continuing on here, let's go to the Mindful Investor Live chart list. Before we get there, the S&P up just under 2%. Again, we're sort of processing the closing ticks here as we record. Mid caps and small caps had a really strong Friday, finishing stronger. The VIX back below 25. Bonds essentially flat, and 10-year yields increased quite a bit, but settled back down. Earlier in the day, it was above 1.6%, closed around 155 or so. As a yield on the 10-year. Gold and silver flat, silver down a little bit. And cryptocurrencies really came on strong in the afternoon. They were down earlier in the day and really reverted higher, although by the end, you can see by the top 10 that we follow, pretty much a mixed bag, but Bitcoin re-approaching that 50,000 level. The Mindful Investor Live chart list, if you've not been on a Friday show before, go to my homepage on StockCharts, which is click on the articles tab, go to the Mindful Investor at the very top. You'll see a link to this chart list. You're welcome to take it, use it however you like. The first is our market trend model. We update this every Friday as of the close. I was wondering if we would actually close above the 5-week exponential moving average. It looks like just barely we did not. So I'll have to say that the short-term model remains bearish. Although it's really, really close, the medium-term model remains bearish as well, and the long-term model remains bullish. So what this tells you after 2 weeks ago, last Friday is when we turned bearish on those two. It's about what the market feels like right now. Short-term, the tactical side bearish, medium-term bearish as well, and that's when I tell you I think we have more to do. That's part of that is looking at that medium-term model and seeing that it's remaining negative. The long-term model remains bullish, and that feels about right. This really only turns negative during a really disruptive phase. The last negative signal was there in late February, early March is when it actually turned negative, mid-March, which is basically recognizing a severe downdraft. We're nowhere near that yet. So it hasn't triggered. So long-term bullish, medium-term, short-term bearish is about how the market feels looking at the individual stock charts. The S&P daily chart we talked about bouncing back above the 50-day does not surprise me, because we don't break through something like that after having not broken through it for months and months, and then just continue plowing on. Usually get a nice rebound on a day like today, and that makes a lot of technical sense if you're more negative in the short term, which I am. Where we're not seeing negative patterns are with the cumulative advanced decline lines, and it reminds me of my conversations with Ari, with Jonathan Krinsky, which were this week, which were really more long-term constructive, thinking about the long-term bullish scenario and seeing a short-term pullback as an opportunity to add to longer-term upside for stocks that have become very overheated. And I get that argument in a great deal. And I think one of the charts that we looked at was the cumulative advanced decline lines in both cases. And you can see that they're just consistently strong. Even though the S&P itself is breaking its 50-day, these cumulative advanced decline lines are not touching their 50-day moving average yet. They're also not hitting their January swing low yet. You need to see those break to indicate more of a broader distribution. We're not seeing it yet. In terms of new highs, you're still getting a decent number of new highs. This isn't updated yet for today, but through the course of the week, you had 25 to 50 S&P names every day making a new 52-week high. That's not bad. That's actually still pretty good. Looking at the percent above the 50-day, this is a concerning one. It actually got below 50% on Thursday. This isn't updated yet for today. I'm assuming it'll bounce up a bit today off of there, but this indicator only goes below 50% during short-term corrective patterns. The percent of stocks above their 200 days still around 80%, and that's probably going to hold on today's close. You wait for that to get below 50% to get really negative about the overall market environment. Not there yet. Sentiment, we won't waste time on it. It's all come down. A 40% swing in the last 2 weeks on active investment managers going more to the defensive side of the ledger, or taking their foot off the accelerator, or starting to tap the brakes is how I would describe that. It's a pretty significant switch, and shows you that money managers are going a little less risk on, not quite full risk off yet, but taking some bets off the table. This chart here, and this is all that we're going to have time for on the Wrap the Week segment, but I just wanted to point out this chart, I think on its own represents where we're at right now. The cap-weighted consumer discretionary versus consumer staples rolling over in a big way. The equal-weighted, not really at all. And this is still in a very clear uptrend. The top one, the cap-weighted one, arguably in a flat trend, if not now in a negative trend, having broken down through some swing lows over the last month or two. This is Amazon breaking down, which is a huge weight in the numerator. And when that happens, it's doing it. So when you overweight the mega caps, it looks a lot worse than it probably is. When you take an equal weighted version, you can see it's still offense over defense. There just aren't a lot of charts in consumer staples that look great. Like tobacco stocks always come to mind recently as a fairly decent set of something like MO, but overall, consumer discretionary still over consumer staples, broadly speaking. A lot more charts in that Mindful Investor chart list. Go ahead and download it. You can if you have a StockCharts account. Take a look. And if you have questions, let us know. We'll answer them maybe in a future mailbag segment. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for our show. We have a lot of fun putting on the show. I hope you guys enjoyed as well. And I was thinking today about just the guests that we had this week, just fantastic conversations. And it's a pleasure to bring some of those perspectives to you. We appreciate all of your feedback on the show and also questions that come up as you're analyzing your own charts. Let us know what you're running into and we'll be happy to point you in the right direction. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching, and we'd love to answer one of your questions in a future episode. Also, as a reminder, our new StockCharts TV on demand is released. It is excellent. I'm super proud of the team for all the effort they've put in to represent the expertise of our hosts, really, really beautifully. Go to StockChartsTV.com to set up a free account. You can access all of our broadcasting anytime on demand, also on all of your mobile devices, your Apple TV, your Roku, your Amazon Fire, whatever it is. Go to any of the app stores. You'll find StockCharts TV on demand. Check it out. It's really, really cool. Our next segment is the Final Bar mailbag. It's one of my favorite parts of the show is to answer some of your questions. And I appreciate all the great, thoughtful questions that you guys have been sending. Let's get to it. Question number one, interested in two charts. Apple is between the 200-day and 50-day. At what point would be a good entry for a long position on Apple? So, I can't answer that in particular. That's the kind of thing I think you have to figure out what's the best fit for you and your risk assessment, what you're trying to accomplish. I can comment on the chart. And when you have a situation where the stock is between the two moving averages, it's interesting. There's a book by Chuck Dukas, D-U-K-A-S, and it's called, I'm paraphrasing, The Trend Advisor Guide to Profits, or something kind of like what I just said. And Chuck was is a strategist, used to be based in the Boston area. I'm not sure if he's still there, but I used to talk with him fairly regularly, part of the CMT Association. And he had a very simple methodology looking at the price, the 50-day and the 200-day. I'm bucketing every stock into one of 6 buckets, depending on the closing price, the 50-day moving average, and the 200-day moving average, and basically how all of them were relative to one another. Craig Johnson at Piper Jaffray has a great methodology doing a similar kind of idea, bucketing stocks and those sorts of things. And so when the price is below the 50-day, what that means is in the short term, it's broken down through the short-term trend. So in the short term, the trend is negative. The fact that it's still above the 200-day means overall it remains strong. In this sort of situation, it remains above the 200-day, you're doing fine. It breaks below the 200-day, you really have to think about, it's technically in a much more of a negative mode. And then at the 50 crossing down through the 200 by a lot of those methodologies, completes that pattern to a full-on bearish chart. Having said that, the problem with that sort of methodology right now is the 200-day moving average is so far away for a lot of stocks that have had really good runs, like a Tesla and others. They have to come down quite a bit to hit their 200-day. That's the challenge with that, is you have if you, in a big upswing, it's just pretty far away. Having said that, where do you look? I would always look left on the chart. In the short term, the challenge I have for Apple, it broke that January low. And I think for a lot of stocks, whether they hold those January lows or not is really key. They break those, they break the 50-day. I think people get a lot more defensive, and you can just see that money's been coming out of Apple over the last 6 weeks or so. And so I think until proven otherwise, you assume that's gonna go on. The other thing I didn't mention right there that I would also be a big fan of using, and we talk about semiconductors here in a minute, I'll do something like this as well, is do the Fibonacci retracements. Take the high and the low, however you define them. On Apple, I'm looking at the low from March. I'm taking the high in September because that was really the peak for the stock. This is more of a blow-off high there. 38.2% is around 105. That's also the low from September, coming off the early September high. I think that's a really decent downside target if we continue to see weakness. Great question, though. Question number 2 on Tesla. Yes, indeed. Let's see. What is your observation? Time to buy, or do you think it will crack below 600? You sent this a couple days ago, so I will now, with perfect foresight, say, yeah, I think it's going to crack 600. I was lucky enough to have sold in January when it was at 880. Now I'm in no rush. What do you think? So, with Tesla, I think with a lot of these stocks, you might want to call these like the ARK Innovation stocks. These are stocks that the ARK Innovation Fund is sort of all in on overall, and this represents sort of the euphoric run on a lot of these names. What do you do with something like Tesla? So here's the thing: at this point, it's pulled back around 38.2%, and that's taking the March low, which was pretty much the beginning of the run for a lot of these stocks. They all peaked in sort of January-ish, and now they've come off. And what now? They're at that first major line. So I'm not surprised we're getting a bounce here. Tesla actually, traded back higher. It was a lot lower earlier in the day. Finished Friday back above that 38.2% level, but I count that as reaching that first objective. That's also the December low. I would not be surprised if we get a bounce here. Today makes a ton of sense. I also would not be surprised, and I'm expecting that we break lower. For something like Tesla, I'm looking at the 61.8% retracement. That's around 400. That lines up really well from these lows from last fall. I think these names have had such a run. I would not be surprised if we go down to that level. Along the way, though, the 200-day moving average, I would expect quite a bounce off of there. This is the first time Tesla's hit its 200-day since March of 2020, and that's where it bounced higher as well. So that's what I think you have to expect on the downside. But on something like Tesla, with these names that have had a bit of an unwind, I don't think there's been enough to really digest the gains that it had up until there. So I'm expecting further downside. A higher low would convince me I'm wrong. Next question. Expectations proved to be correct. And that was a Twitter comment after my chart on semiconductors. And thank you for that. Boy, you're not always right, and in some cases often right, but I will definitely acknowledge that I've been talking about this bearish divergence, and certainly the weakness that I've seen this week is the sort of move you would expect out of those conditions. So I think that was a pretty decent tell on the chart. Do you have a target for the downside move? And yeah, I mean, what I would basically think about is just like we did with Tesla. I think with all of these charts, this is the kind of thing I would be doing, which is taking the Fibonacci retracements. If you look at semiconductors, they have quite a ways to go, around 200 actually, to get to that first downside objective. And so for me, that's a decent pullback. That's 38.2%. That puts us to where we were last November. That's still not that far away from where we're at. That's only 20-30 points away. On the SOX index, that would be around 2,500 on the SOX index, the dollar SOX. I think that's decent for a pullback, and at that point, I'd reevaluate it. But at this point, I think it's weak. This is one of those that has a hammer candle, and so short-term bullish. And what I mean by a hammer candle is if we just look, let's see, candle focus. I think this is a good, yeah. So look at this one, right? You have this pullback, and then you have this hammer candle, open and close at the highs of the day, pretty close, a long lower shadow. That suggests a bit of a short-term bounce. I could see that happening beginning of next week before a continued downtrend. We'll see. Hypothetical question: what happens if Powell comes out and says the Fed will consider negative interest rates? That's a tough question to end on, because that's like a whole episode, if not a special, to focus on that. Maybe that's something we need to do. I did think about that. Guys that I know that are institutional investors, I know in periods like this, what we would do is walk down the hall to the high yield desk, walk to the talk to the fixed income portfolio managers, because they had such a better awareness of risk. If guys that, institutional investors, equity guys, if you think of the growth equity investors, it's all about the Teslas, the home runs, the Facebooks, you're trying to think long-term, and I'm thinking growth-oriented management. You'd go to the bond desk and they wouldn't be thinking about shooting the lights out. They're all just about managing risk. It's all about duration. It's all about thinking about downside risk and a company's ability to match it, meet its debt obligations. And so it's a very different way of thinking about it. And equity guys, I know someone like Steve Supmeyer, who started on the fixed income desk, I think are really well equipped for this sort of environment, because you're used to thinking about the risk side of the equation. So what does that mean about negative interest rates? Certainly that's happening in pretty much most of the world, except the UK and the US are the two major economies that don't have negative rates yet. But Japan, you do, and in Europe, you do. The world didn't end, so that's good. And actually, the news article I just read this week was about German banks turning away deposits, which is kind of an unusual thing, basically saying they don't need the assets. It's too expensive for them to take your savings account right now. So, is that something, the message that we've gotten from the Fed in the US certainly has been that's not something on the playbook anytime soon. Could it happen and will it happen? I wouldn't be surprised if it does at some point. I don't think that's happening soon, though. I think they're dealing more with a rising rate environment and needing to raise rates at this point to match the upswing that we've had. Given what's happened recently, though, I think that's a tough thing. That's certainly going to put some pressure on stocks, but we'll see. That is our mailbag segment. Thank you all so much. We have other questions we'll get to early next week. If you have your own, shoot us an email and let us know. Hopefully answer one of your questions in our next segment. We need to wrap the show. I'm a little long on time, surprisingly, and I'm joking. I'm usually way long on time. 3 and 3, 3 charts, 3 minutes. We'll do it quick. Peloton, PTON. Again, we looked at Tesla. We looked at semiconductors. I think Peloton, similar chart. I think a lot of these now have pulled back to that first line. With Peloton, for example, it's the 200-day moving average. It's the November low. Look how beautifully it's lining up with that. This holds going into next week. I would be amazed if we didn't get a bounce off of that, especially at an oversold level. So I think you get a bounce going into the beginning of next week. And then the question is, what next? I think this resolves lower. And I think you see things like this breaking, the previous support levels. And I think that's when you get another big wave of selling. That's when people start to not believe or start to embrace the fact that there's further downside. But first things first, has to break the 200-day. Chart number 2, reminder of the long-term perspective. When I'm talking about all this pain, I'm talking about all these support levels that may not hold. I'm thinking of the short-term time frame. I'm thinking about how much the market needs to alleviate the previous euphoria. I'm not saying we're entering into the 1970s in a big secular bear market cycle. There's not enough evidence of anything like that anytime soon. Overall, things are still fairly constructive. And I think the long-term conversations I had this week reminded me of that. The cumulative advanced decline lines remind me of that. You see these break their moving averages. You see them break their January lows. You will hear me get a lot less constructive on the long term. And wait for it, though. It's not happening yet. Finally, let's finish on a pretty chart on an attractive uptrend. Stocks like Apache continue to impress. It's one of the top ranked stocks, and overall, I think holding up beautifully, continuing higher highs and higher lows with plenty of potential for their upside. Strong relative strength. Good chart. Folks, that's a wrap for this week. Thanks so much for joining us on this journey looking through charts together. Appreciate all of your feedback and your questions. Keep them coming. StockChartsTV.com. Set up a free account. Catch all of our content. For StockCharts TV in Redmond, Washington, I'm Dave Keller. Be safe. Have a good weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.